This is the last in the current series of Vantage. Delighted to have a UK small and mid-cap specialist on as the last interview for this season. We will be back in September with a new season, but I wanted to wrap up with someone who's got a very disciplined approach to investing, targets 15% returns per annum, and that, as he reminds me, doubles your money every 5 years. Let's go take a look. Welcome back to Vantage on this sunny day. I'm privileged. There's a man I've tracked and watched over a number of years, but finally get to meet him. Delighted to have James Thorne on the show. He's a UK small and mid-cap specialist. We're here to learn a little bit more about the funds he manages and his approach. Welcome to the show.
Hello, thank you for having me.
To start with, do you want to open with just the funds you manage, and you co-manage some funds as well? So I just wanted to give people a picture of, what you're looking at on a basis.
No, I mean, I'm very fortunate and I get to look at a huge spectrum of companies. So I run the Threadneedle UK Smaller Companies Fund, where we invest in companies from around 30, 40 million market cap, all the way up to the top end of the Numis index, which is the bottom 10% of the FTSE 100. I co-manage a mid 250 retail fund, which obviously is the mid 250 index and dabbles a bit in the bottom end of the FTSE 100. And I also manage some institutional mandates and some sovereign mandates, but they've got their own indices, which we're allowed to basically a wider scope of pretty much the whole market, x the top 60, 70 companies in the FTSE 100.
Okay, and you also co-manage a sustainability fund?
I work on a sustainability fund. I've been demoted to deputy. I did used to co-manage it, but I'm now deputy. And that's to give me a little bit more time of focusing on the small and mid-cap space. But I'm still very interested in sustainability. We can come on to that.
Okay, perfect. And I guess always instructive to understand where you've come from. So just a potted history of the career journey that brings you effectively to your role today.
Yeah, well, I have Alliance and Leicester to blame for where I've ended up, because I had a Alliance and Leicester account just as I went to university, and I got all these shares. And my family background are all scientists, teachers. We hadn't, I hadn't really thought about finance. I was going to maybe think about it in the future. And I got these shares, and as a student, that was quite a lot of money, and they kept going up. And I, was interested in. I had no understanding of what the value of these things were. So I started doing some research. I bought an FT. And I was just interested. There was a lot of numbers, a lot of figures, a lot of what I'd been doing chemistry, physics, and mathematics, and was really, fascinated by it. And so I kind of, at that point, actually, when I finished my university studies, decided to take a turn of direction. And so to get into the market, I started at Abbey Life in Bournemouth, who then got merged in with Hill Samuel, worked at Hill Samuel briefly. And then really, really wanted to get the grips around companies. So I ended up working for 3i for the private equity business on the quoted side for 5 years, and really got a deeper understanding of companies. And then from there, I got my first fund manager role as a lead fund manager at Barings for a few years before I settled on working at Threadneedle, where I've been for 12 years now and thoroughly enjoying it.
Very good. And I've watched and read some of your literature, and some of what really comes through is you are an advocate, a great believer in the smaller companies effect. I guess in the current environment where we are looking at a high inflation outlook, I wanted to understand, is that still valid? Is it relevant for the cycle we're about to go into, or should we be focusing on larger companies with greater pricing power and greater liquidity because there's going to be volatility in the market?
Well, Neil, obviously you know what my answer is likely to be, which is, they're fine. But I think the best point is to talk about the data. And I think especially in moments of market stress, you need to go back and look at the data to give yourself confidence about where we sit. And the data suggests that the small company effect will remain present. And over the last 50 years, it has been present in all but pretty much 3 or 4 years. And that adds about 3 or 4% returns. And that has been through periods of high inflation. So that data set goes back through the 70s, through the 60s. So even when we're looking at headlines of saying inflation's running at 30-year highs, that data set is relevant even now, even under that stress. I think the second point is your point, which is interesting, and I think this is interesting where it links to the psychology and emotion of investing, which is very, very powerful. And I guess as a professional investor, you're still a human being, and that emotion, comes into play. And at that moment, you have to go back to the principles and the data sets. And if you look at the data sets, small companies don't necessarily underperform in periods of inflation or recessionary periods from an earnings point of view, from a fundamental point of view, but they do from a share price point of view. And that's really driven by liquidity.
Yeah.
And that's ultimately what creates the big opportunity in a gap between fundamentals. So if you look at the last 7 or 8 recessions, the earnings decline of smaller companies is not worse than the FTSE 100, but obviously the share prices are, and that's primarily liquidity. I think the interesting thing is, back to that psychology, is a lot of people say, well, that can't be true, and that's really because there are so many more smaller companies, and so seemingly there are more profit warnings and more headlines in the press of smaller businesses getting into trouble than there are larger businesses. And that, combined with the share price, draws people to that conclusion.
Okay. I'm assuming that you're scouring the market looking for opportunities, given the sort of tough start to the year.
Yeah.
Yeah.
No, the problem is, as has been saying to clients, it's like a kid in a sweet shop, and there's huge numbers of opportunities. You're not sure which sweets to eat first.
Yeah.
But also there is this issue of probably the best opportunities are in companies that are economically resilient, whereas than economically defensive. There's a real desire, back to that psychological, it's almost like touching a hot kettle. Your arm retracts from anything which carries any risk.
Yeah.
And we're seeing that in the market at the moment, and buying very defensive businesses. Now, they are great quality businesses, but considering how the market's fallen, the opportunity is really in economically resilient companies that have been sold off, and people view them as highly economically sensitive.
Okay. You talk about targeting a 15% return per annum, and is that still the case for the outlook that we have, and if it is, how do you break that down in terms of return for equities, the smaller company effect, and effectively what you bring from active management?
Yeah, no, I really interesting, and I appreciate that question, because a lot of people always ask us, well, and being a sort of massive advocate of smaller companies is, well, what should you expect over the long term?
Yeah.
And that this asset class is very volatile. And it can be very volatile in moments of extreme stress. But if we go back, actually the volatility is not that much greater than the wider market, but the returns are that much higher.
Yeah.
And to that 15%. So if you accept that maybe an equity return, a broad equities return, is between 6 and 6.5%, which I think is a reasonable place to start. And you then say that if you look back in history at the small company effect, and this is a global effect, you're getting to about 4% over the last 60 years, evened out. That is what you'll get on addition to that. So that gets you to about 10.5%. And then if you look at most of the fund managers in the top quartile over the last 10 years, admittedly the last 6 months has been difficult, but if you do it on a rolling basis, then on average they add about 4% of outperformance. So that gets you to about 15%, which of course is a doubling of your capital value every 5 years, which, compared to other equity returns, and I always put that in place, having worked at venture capital, where everyone talked about the rate of return and sort of looking at about a 17%. But that's a geared return. So the average gearing in sort of private equities, 3 or 4% at the bottom end. The gearing in small companies is much, much lower than that. And yet your returns are not far off. And you get daily liquidity. And the individual walking down the street can go and invest in smaller companies. You can't go invest in private equity funds.
Yeah, no, interesting. And that 15% number is definitely, the fact that it doubles your money every 5 years is something I think people need to hard code in their heads. Yeah. So look, that's the approach. Now you look at the market. Be interested to see, what are the typical characteristics of a company that draws your attention? Because you will have a pick of, look, these are the types of companies I like to pick, and maybe you can illustrate that with a couple of examples.
Yeah. There's a huge spectrum of companies in different sectors, but in actual fact, the principles of what we're looking for are very, very similar.
Yeah.
And the starting point is really your ability to charge a good price for your product or service. And that might be because the market's growing. That might be because you add a lot of value to that product. Or it might be because there is a sustainable perceived value to what you're creating, such as a brand. And once you've got those attributes, then you have the capability to create a business around a product or a service that can compound returns. So once you've found a business that's got a product or a service that has those attributes, that you're then looking to how much capital would it need to effectively try and sell more of those products or services. If it's very capital demanding, you don't want to be looking at that as a small company. And quite often there are examples of companies that are great on paper, but they need quite a lot of capital. And they should be really looking at infrastructure funds or other sources of capital. And then I think the next thing is around people. You need people who run a business who really have either done it before or really understand a balance of what the risks might be that are going to trip them up, and invest in people and the business for the future. And this is, I think, what links into sustainability and how we view sustainability, because when I took on the sustainability fund, I was a bit cynical about, well, this is really about exclusions and about getting rid of certain points. And what I realized was actually what you're trying to do is businesses that do the right things in investing for the future and not exploiting areas of the market. And that delivers you very good, stable returns.
Okay, interesting. So give me some, I asked perhaps to bring it to life, maybe some companies that sort of demonstrate that.
Yeah, no, of course. So one of the businesses that we really, we're a large shareholder in is a company called Hotel Chocolat. And I use an example because most people might have had some involvement in the business. They might have bought some of the chocolate, tried their hot chocolate machine. And really, this was founded by a gentleman called Angus 30 plus years ago. And I think there, you could look at a model of Thornton's, which went terribly wrong. And that was an example where the starting point is that you have a product that's really nice, it's very high quality, and therefore you can charge a good price for it. But how do you take that forward? And I think in terms of taking it forward, what was different was how the business innovated and went forward to take opportunities of new markets. But also they understood that point about capital. So they're always very, very focused on making sure the business didn't consume lots of capital. And if you put it to like a business school, on paper, you'd say, build a massive, great factory, make it as efficient as possible, and then market your product and push all the product through. That's the best way to do it. But what they realized was then the factory controls your whole business. And that's what happened in Thornton's. And so what they've wanted to do is build flexibility into the company, but also to create products that people love that actually don't require a huge amount of machinery. Actually, it requires care and attention about the provenance and where this product has come. So what they've done is built flexibility in how they manufacture, come up with some great products that don't require this huge lump of capital in the factory, but also taken a huge amount of care about where their chocolate comes from. They bought their own plantation and they understood horticulture, how it worked and how they could build it in a more sustainable way. So whereas some countries, I think, some companies are going through a box ticking exercise about sustainability, they really wanted to learn how they can make it better and how they can actually therefore make their products better for their customers.
Excellent. And I remember it coming to market, and it's been a sort of fantastic journey seeing it grow. So good example of a business which effectively just kind of compounding returns at the same time. So look, when you see a business that meets those attributes, what's the process that you go through to effectively validate it? I'm trying to understand, the checks and balances that you and the investment team take to give yourself comfort that we're investing our clients' money in the right place here.
Yeah. So I mean, the first thing is to the point of looking at the business. So the point we start with is the gross margins. So this is the profit on the products before you've had all of the costs of central office of getting it to market. And then we look at about how is it going to get to market. And what we do is we look at comparable models. So we look at models that have succeeded and what is the strategy that they've outlined and is that realistic? Have other businesses succeeded using the strategy that this company has used? And that's the same in terms of the manufacturing, whether you're manufacturing a service, i.e. you're taking people on and training them, that is effectively creating a resource. How are you doing that and is that being done in a sustainable way? I think the other point is how you develop people within a business. So businesses that are growing, that business will need to change over time. And businesses that accept change and want change within how they're managed and how the board's structured is incredibly important. And these are all qualitative things that go hand in hand with us working out through the financials how we expect the profitability of this business to develop over time and how much cash will that business need to effectively deliver what it wants and how much cash will it generate for shareholders. So there's a lot of the accounting side and going through the report and accounts and constructing models. But the point is, those models aren't only as good as the quality of the figures that you're putting in.
Yeah.
And that's where the qualitative piece comes to part, which is that whole point about benchmarking against other businesses and what they're doing, but then also going visiting in companies. And we like to go and visit companies, and it's been great since basically COVID restrictions are off. We've been out visiting companies in the UK, their operations in Europe, and maybe hopefully further afield if we can get the budgets to do it. But that really adds another level of understanding of a business.
Very good. And then how much do you use external sources? So do you use the broker network? Do you use third party experts, etc., in terms of validating the views, or is it in-house?
I mean, across the business, we do use some third-party experts, but we have a huge amount of resource. I mean, in Ameriprise and Columbia Threadneedle, we have a lot of dedicated analysts in the US, but also in Europe. So on specialist areas, we use those to get that understanding. If we say we're going to do benchmarking, we need to have somebody who's an expert in that area. And we have a lot of internal resource to do that. In terms of broker research, I think independent research is incredibly important. And I think also, analysts who have looked at lots of different businesses and spent a lot more time necessarily than we have building the forecast together, those conversations, those relationships are really important because we can test our own models or our own views against people that we trust and have been around for a long time. At the end of the day, investment is, experience in investing is very, very important. So pulling in people we've known for a long time is very, very important. What we don't do is necessarily take a lot of incoming calls from brokers telling us that we should go and necessarily, have a look at certain businesses. We set that out ourselves from the starting point.
Okay, good. I guess there's two areas to touch on there. One is, you're looking for profitable businesses growing that can fund themselves. That in itself leads to looking at, themes, areas of the market or sectors or sort of mega trends that you think are going to lead to growth in certain areas. And I'd like to touch on that. There's also certain sectors that, you tend to avoid because companies don't necessarily tend to fit. And let's start with that because, the fund hasn't been in things like oil and gas, mining, financials historically. I just wondered, as you went through effectively this first quarter where, it was the pain trade. A lot of people who were sort of outside of oil and gas suddenly saw the sector sort of perform really strongly. How do you cope with that? Psychologically, how do you deal with that?
Go to the gym occasionally to de-stress is helpful. I mean, it's difficult, but we don't invest in those sectors generally. And it goes back to the point we said about data and fundamentals. So most mining companies struggle to meet their return on capital over their cost of capital over a cycle. And ultimately, they're commoditized businesses. Now, the problem at the smaller end is many of those businesses have single assets. They have one mine that carries huge amounts of risk to it, quite often in countries where the risk profile is very, very high and they can change taxation, the stability can be very, very different. And ultimately, that's not really alpha in taking a view on a commodity. I certainly don't have a view about where the oil price will be in 6 months or 3 years. And if you look back on history, the market has been very, very bad about actually predicting or forecasting where it will be. And that's the same in the commodity space. It's not to say that we don't, and there is one small business in the portfolio that's a royalty model, and that's quite diversified across many, many different assets and exposed to a group of commodities where we actually think if we look to, like lithium, where you think there is a very, very good, solid, long-term prospect, and we would say that we might not know exactly what the lithium price is going to be, but we're certainly seeing that will go up at a rate higher than inflation. In terms of the banks, I mean, it goes back to that point about needing capital. So the problem is, as a financial business, especially balance sheet businesses, is you need third-party capital.
Yeah.
And if you're a smaller business, that third-party capital is so much more expensive than the incumbents. Now, we are interested in sort of fintech, where there's a platform where you aren't actually needing to consume loads of capital. But the regulator ultimately wants large financial businesses that are very robust with very deep pools of capital they can fall upon, and that's really why we've tended to invest in relatively few financial businesses.
Okay, and then looking at the other side, perhaps more interestingly, you touched on lithium as a something that and behind that is, I guess, the whole sort of EV electrification drive. Are there key themes that you're sort of attracted to, where you think there's going to be growth coming downstream for companies?
I think there are lots of areas where things are going to be interesting. I think the EV market is quite difficult from a small company point of view, because there are a lot of people with very deep pockets, back to the point of capital.
Yeah.
And you can't actually charge a high price for the product or good, back to that point, because basically it's going to be mass consumed and that price is going to fall. And you're creating a product where you need to build a massive great factory, as we're going to build some gigafactories. So from a small company point of view, it is quite difficult. But there are a lot of areas associated with that and sustainability that we are invested, where in actual fact you have businesses where they've created a toolkit that's going to be needed globally. And in the portfolio, there are a couple of businesses around geospatial software.
Yeah.
Now, those businesses effectively are helping the efficiency, not just of EVs, because you're going to have to invest in the whole utility network globally to allow EVs to be plugged in. And these are software packages that allow you to understand where your assets are when you're building that out, and do that much more efficiently. And there you've created some software once, and you're going to sell it to the whole of the US, the whole of Europe, the whole of Asia. And the great thing about that is software adoption in those markets is very different to consumer software. So the problem with consumer software is that it's adopted really, really quickly. Also, like some areas of enterprise software, like security. So we've seen some security software launched on the stock market. The problem is the cycle of new products in security software is 18 months. So for us to try and assess their positioning in the market in 18 months and whether it's going to be there in 2 years is impossible. The great thing with this sort of utility software is that basically your investment cycle is 20, 30 years.
Yeah.
So we've been invested for a long period of time, and we think we're just only coming into the phase now where it's going to get really interesting. And that's back to the point, those businesses don't need huge amounts of capital. They can charge a high price for their product because it delivers so much value to their customers.
That's good. So let me summarize, and then we can wrap up. The approach comes across as something which is fairly disciplined. It's something looking at data. You seem to be sort of, I guess, take the emotion out, go back to the fundamentals, look at the data, find companies which are going to grow, charge a sensible price, don't demand a lot of capital to do that. And that's going to afford you the returns that you're looking for. You do look for areas in the market where there is, I guess, secular growth. So the themes are interesting, and there is this sort of build-in of a sustainability element, because I think you're right that sort of builds good quality long-term businesses. If you run your business on that basis, it's a sign of high-quality business.
And I think one of the things is about investment. So we talked about high quality businesses, but if you invest, probably more than really you might need to for the next year or two, but you invest for that thing that you can't see, that means you're buying a company actually at a much lower valuation than you think, because you've invested for all this future profitability. And there is a big disconnect between those businesses that are hot right now, that have got momentum, and they're not investing. And they actually, people perceive that those businesses are much better and higher quality and value them too highly. And you really want to invest in those businesses where that investment is really probably going too far out. And going back to Hotel Chocolat, they're investing for, 2027, 2028. And as a result of that, there's a disconnect in terms of maybe how much investment, how much they look valued today than they do in the future. And I think that is a key point, and a key opportunity that always exists in smaller cap companies.
Yeah, and then look, I like the approach of once you've sort of identified those companies, you do the work. You know, you keep the ties, you go through the accounts, you leverage your own team, you benchmark, you go on site to visit, and I think you get a great feeling of a business when you're suing it. So that and then, you know, that's targeting effectively the doubling of your money every 15 years, the 15%
every 5 years.
Sorry, every 5 years, and that's effectively what the attraction is, effectively of the funds that you're managing. That's a fair summary.
I think that's a very fair summary, and that's what, and also why it's so exciting is because there's so much opportunity to invest in businesses that have those attributes. And if you look at the FTSE, you know, the larger end of the market, that opportunity doesn't exist.
Okay. So, you know, I would summarize. The final question for you is that, you know, I guess from studying oceanography and picking up the FT, and getting into this industry, you come a long way. If you you know, we have a lot of people who look at these sort of programs as part of their own investor education. So my question to you would be, you know, if you were to advise your children about their sort of financial future, what would you be saying to them?
Well, I slightly dodged the question, and I've realised trying to advise my children is a nil-sum game.
Yeah.
But what I've tried to do as a starting point is, and this actually goes back to actually companies and management, is actually appreciating the value of money.
Yeah.
In that money is not an infinite resource, and to get the children to actually, you know, use money, allow them to go and spend it physically, or even, you know, on a card, so they've got a Go Henry card, so they understand how saving works. So, you know, right at the very outset when they were 3, you know, they had, you know, saving boxes, they put money in, and understanding if you save up money, then you can do other things with it than if you're constantly trying to save it. But also spending, and this goes back to like management teams are spending on CapEx, is that spend the CapEx on something that, or spend your money, your pocket money, on something you really want, or something you really need. Not something just in that moment you think might have been a good idea without really thinking about it. Because actually, if you start to do that, and it's sort of this, you know, this old principle of being sort of, you know, very prudent and spendthrifty about your money, then in actual fact your money seems to go an awful lot further. And so yeah, I mean, my kids are relatively young, but that's really what I'm trying to get them to do. And hopefully that, rather than giving them outright advice, will work.
I love the fact that you describe it as a zero-sum game. I go through exactly the same thing with mine. Jake, it's been a pleasure having you on the show.
Well, thank you.
I hope the year pans out well. I'd love to get you back. You're actually the last of the current series, so thank you for wrapping up the current series. When we kick up the next series in September next year, I'd love to get you back to reflect on the year that's been, because it's been an interesting start. Love to see how it develops and hear more about the stocks that you're looking at.
Yeah, no, that'd be a pleasure.
Thank you very much.
Thank you.